It's going to take away a lot of the business away from index funds and ETFs and bring them forward back, into active management, which has not, existed for many years.
Peter, looking ahead to the future of AI and indexing and investing, it feels like we're still in the early stages of this evolution. How do you see the space developing?
Since the beginning of time in asset management, in investing in public markets, there's always been this consistent relationship between risk and return. The risk of investing in a certain product or a certain security or a certain index versus the expected return. The more risk traditionally that you assume, the higher your expected return would be. But at the same time, again, the higher the risk. I think the real value in this domain of AI is really in terms of basically just upending the risk-return relationship. By that, what do I mean? I mean that we can actually maintain a fairly constant risk attribute while at the same time increasing the projected return based on AI, based on the enhanced information that's provided by the AI model. But if we can prove otherwise, that we do not have to assume more risk to actually realize a higher return, then I think that's really where the future lies, because to date, portfolio managers, active portfolio managers, including hedge funds, have had a hard time, especially in the past 20 years. They have not been able to consistently beat the benchmark. For example, the S&P 500 in the US, the broad market, or the technology, the NASDAQ 100, or the Asian markets, the CSI 300. So they have not been able, no matter what kind of resources and what type of portfolio managers and analysts they've employed, they've not been able to beat the indexing, which basically led to the realization that sophisticated investors have basically taken the money away from active portfolio managers because of the high fees and just invested in index funds. And because of that, the whole active portfolio industry has really lapsed and has more or less shut down for the most part. A lot of these high-powered hedge funds that you heard about in 20, 30 years ago no longer exist. They just went under. So I think what we're going to do is bring back active investing. What AI does, it brings back active investing. Active investing is defined, the goal of active investing is defined as realizing alpha. And the definition of alpha is basically the excess return of the index over the market return. That's where a sophisticated investor, or any investor for that matter, would not mind paying an enhanced management fee to capture a higher return. But if they're not able to capture a higher return, they do not want to do that. But through AI modeling, we have been able to realize at least a 30%, alpha return for the past 3 years. And in the CSI 1000, where the market actually, depreciated over the past couple of years, we were still able to realize a significant positive return, not only over the negative return of the CSI 1000, but over the zero return, a flat return, which is pretty amazing.